Are you one of the 750 firms affected by the next wave of uncleared margin rules? Is your firm in scope for Phase 6? Do you need to start planning but not sure where to begin? Acadia has supported nearly all in-scope firms with their UMR requirements. We help firms understand their initial margin exposure and ensure they're on track to be fully compliant with the rules. Download our checklist to help you prepare for Phase 6 Uncleared Margin Rules today. Acadia, driving the derivatives industry as one.
Hello, and welcome back to the afternoon session of this year's Securities Finance Technology Forum, or Symposium, I apologise. Hope you managed to enjoy some lunch, and for those of you who had coffee, enjoy your coffee as well. Just a little reminder to everybody to please use the questions on the virtual platform. Those questions get fed straight through to the moderator. And I think the questions so far this morning have certainly helped, I think, stimulate some very interesting debate. On the whole, I found the whole discussion this morning to be very, very interesting. And in fact, in the last session on collateral optimization, we had a nice teaser, I think, for the next one on UMR. Well, in getting up to speed, I've been reading a little bit around UMR and how the implementation is going. There was one particular article I read entitled what is UMR? That made me smile. I thought it was quite inventive. But anyways, moving swiftly on. I'm looking forward to this panel because I think we're going to really hear about what the current sort of state of play is with regards to implementation, the challenges for the firms that are going to be affected or have been affected so far. On that note, I'm going to hand over straight away to our moderator for this session, who is Shaun Murray, who's the CEO of MarginReform, who's going to lead the panel discussion on margin reform, I think in a broader sense, I think, Shaun, and UMR. Over to you, Shaun.
Thank you, Kevin. Thank you very much. Just as a starter for 10, I didn't have anything to do with the naming of this panel. How it's ended up the same name as the company, I'm not sure, but I'm Shaun Murray. I am the CEO of MarginReform. We will be spending some time today drilling down into margin reform and uncleared margin rules. Who are MarginReform? We're a boutique consultancy and we work with organisations of all shapes and sizes with regards to collateral margining and legal across the derivatives and securities lending markets. I'm joined today by 4 very esteemed panellists who are now allowed to introduce themselves. Katie, if I can start with you, please.
Thank you, Shaun. My name is Katie Emerson, and I lead the sales effort in EMEA at JP Morgan for our agency finance and collateral management products. So been extremely involved in UMR to date with our tri-party and our collateral management products.
Thank you. Nick.
Hi, my name is Nick Shaun. I'm COO of HQLA<silence> , and the HQLA¹ vision is to accelerate the financial ecosystem's transition towards frictionless ownership transfers of assets. And our more immediate goal is to improve collateral mobility amongst market-leading tri-party agents and custodians. Together with Deutsche Börse, we've created an operating model that combines a Luxembourg-based legal structure with distributed ledger technology, which allows clients to exchange ownership of baskets of securities across different collateral pools without physically needing to move the underlying securities. We are currently in the process of connecting 6 tri-party agents and custodians, and our initial product is a securities lending upgrade downgrade product where the ownership of the baskets of securities can be exchanged simultaneously, even though those securities are in different locations. And in response to client feedback, we're currently exploring applying the same HQLA¹ model to also provide efficiency gains for clients satisfying their VM obligations. Overall, the benefits of the model are capital cost savings by helping to reduce credit risk, intraday liquidity requirements, as well as operational risk.
Great, thanks, Nick. John?
Shaun. John Pucciarelli. I am head of regulatory and industry strategy at Acadia. Before I joined Acadia, I was at ISDA and I led the phase 1 through 4 compliance efforts for UMR from an operational business perspective. So it's good to be here, and thanks for joining today. Acadia, as some of you may or may not know, we're a fintech firm, kind of smack dab in the middle of the uncleared margin rules. Our solutions help clients at all stages of the OTC derivatives and risk management process. We have over 1,600 clients that calculate over $600 billion in IM regulatory exposure, exchanging over 650 billion in collateral every quarter. And we have about 15 million margin calls a year we process. So we have, we're kind of right in that the collateral and risk world, and our IM, which is our IM Exposure Manager service, really has become the industry standard for regulatory initial margin calculation and reconciliation. So it's good to be here. Thanks, Shaun.
Thank you, John. Mark, over to you, last but by no means least.
Sure thing. Hi, Shaun. I'm very glad to be here. My name's Mark Jennis. I'm responsible for strategy and partnerships at Transcend. Our focus in Transcend is really optimizing inventory funding and liquidity. And we support multiple businesses from the OTC derivatives to repo, to prime brokerage, et cetera. And we look at things across the enterprise. My background is working at DTC. I was responsible for a utility called Global Collateral, which was a JV with Unclear and DTCC, and then a long career at Morgan Stanley and Bankers Trust, all in the collateral businesses or supporting the collateral products. Thanks. Happy to be here again.
Fantastic. All right. Thank you, everybody. So I'm going to suggest we kick straight off, and we're going to talk first off about the Uncleared Margin Rules. So we know that Uncleared Margin Rules have been around now since they've been around since about 2013, 14. We first started going live in 2016, but very recently, phase 5 of the initial margin requirements have gone live, or went live on the 1st of September, with around 300 clients impacted. It was the largest phase so far. Clearly, there was a lot of smaller entities that had come through into phase 5. The whole process for initial margins, it started with the largest organizations, the tier 1 banks, and is now moving through into smaller organizations and the buy side. The buy side reality in real terms joined in phase 4, but phase 5 and phase 6 is expected to be much larger on the buy side than it is on the sell side. And we want to really explore how things have gone since go live a couple of months ago. John, as you've already said, Acadia have been front and center of UMR for a while, for a long time. So maybe you can share with our audience some of the relative challenges, the successes of phase 5 and how the go live has gone.
Yeah, thanks, Shaun. I'll first start off and I'll give you a few stats and some numbers. I mean, I think, from my personal experience and kind of being on, in depth involved in this effort since really day one, Shaun, as you know, and you and I have been kind of looking at this for quite a while. There wasn't a lot of surprises going into phase 5. I think, as we started to look at the numbers from an industry perspective, even from an Acadia perspective, we were estimating, I think you said around 300. I think we were estimating about 330 firms. Again, as you said, largely smaller firms, mid-sized firms. The ANA calculation was 50 billion of aggregate notional for those firms. So no real surprise there. We kind of knew those numbers for quite some time. And from our perspective, we're doing business with about 310 of those 330, or so to speak. So, no surprise there. I think, generally speaking, from our point of view, things went really well. We were happy there were no surprises. And, it doesn't mean that there wasn't a lot of late nights and a lot of hard work to get all of those firms over the line, because there were. And I would suspect that if you talk to any other fintech firm or any other vendor or, any of the banks and the custodians that have been involved in this process, they probably tell you the same thing. Things went well. People got across the line for the most part. But it was a lot of work. And I don't think that was a surprise at all. I think everybody kind of knew, based off of those numbers and comparing them, as you said, from the previous phases, which were a lot smaller, especially this last phase 4, that we knew what was coming. I think, and I don't want to talk too much about COVID, but getting that year delay, I think really helped set up these firms to give them a little bit more breathing room just to get their ducks in a row and get everything in order. So I definitely think that helped. I think efforts like, Acadia launched what we called soft launch, which was, kind of taking advantage of that extra year that the regulators had given phase 5 firms back in 2019 to kind of get in early And I know a lot of other firms kind of did the same thing, test early, get your netting sets in, get your ANA calculations done. And I know we'll go through a bunch of this other stuff, but I think overall it went well. And I do think that all of the lessons that we had learned from the previous phases definitely served us well, including, the challenges mainly around negotiating docs, negotiating your eligible collateral schedules, and getting your custodial docs in a row. So, that's kind of it. I think, from our perspective, I think, we had something like, and of course this, I think right now, looking at phase 6, we've set up about 2,200 Reg IM CSA agreements, and we have about 6,000 Reg Monitor agreements. Those are firms who didn't go live, didn't go live in terms of exchanging collateral, because they were under the 50 million threshold, but are going to be in a monitoring state. And I guess we'll talk a little bit about that when we talk about phase 6. So, we'll kind of look at those numbers as a benchmark for the next phase, so that we can, scale and prepare. And I think, a lot of other firms who are involved in UMR will be doing the same thing.
Cool. So positive vibes to kick us off, John. So thank you. I think that's good to hear that things were managed. Yeah. And I think, as you say, the extra time was probably a blessing in disguise. Katie, I know you've obviously sat on the dealer side and have gone through various phases, and now we're getting into the crux of working with clients who maybe are not quite as sophisticated when it comes to collateral management, and maybe haven't gone through regulatory challenges like the sell side have over the past few years. What did JP Morgan see through phase 5? What were some of the client challenges that came up that might reappear in phase 6?
So I guess, sort of speaking, JP Morgan as a collateral manager and a tri-party agent, I think that, we definitely had some clients that were extremely prepared and pragmatic in their approach, but we definitely had a lot of clients that were really racing across the line on the 1st of September. So I think it was sort of a mad dash to the finish. I don't think everyone took advantage of the year delay in terms of their readiness. So if I think of a few of the sort of key challenges, I think these were very complex projects for these buy-side organizations. And I think that, they had a range of stakeholders within the companies. I think the oversight and the group nature of some of these companies made these projects, quite difficult to navigate and execute upon. And, to pick up on John's point, and I think we'll hear this again and again, the legal negotiation was a much bigger part of the process and a much bigger challenge, I think, than anyone had anticipated. And much of that went on very down to the wire. And that's not really legal agreements so much with collateral managers like us to provide services. It was really the legal agreements between clients and their counterparties in relation to either their account control agreements or in relation to the amended CSAs and eligibility criteria. So I think that, we saw a lot of negotiating on eligibility until the very end. I think that clients learned a lot in terms of trying to agree eligibility that was far too complex and wasn't potentially supportable. So that's a real lesson as we move into phase 6. So, and I think that the setup from a collateral management perspective, as we were an agent trying to get ready for our clients, the legal delays, were quite difficult as we were trying to get near go live, and the scope, was gradually shrinking as people were narrowing down the number of counterparties they felt were necessary from day one. So I think that those were some of the sort of challenges and complexities. And I think also, phase 5 was hugely different in terms of the tool set, because it was a different type of client, right? So phases 1 to 4, the banks were really making and managing their margin calls themselves, and then relying on the tri-party agents to hold the collateral. And as we moved into phase 5, these clients needed, they needed the industry to help them move further upstream. So, with these clients, we were extending our service offering. It was the first time for everything, right? In terms of agents providing the calculation, the reconciliation, and all the other services the buy side needed. So I think that it was a huge shift in the market in terms of the operating model. And with that, as I said, phases 1 to 4 were entirely supported in tri-party. And as we moved into phase 5, we saw that, that wasn't always the case, that some of these clients wanted custody control or third-party accounts instead of traditional tri-party structures. So, the custodians were doing a huge amount of work in the market to get those agreements and that framework and that operating model up and running. So I think that there's a lot that we accomplished in phase 5. There was a huge amount we've learned that sets us up really well ahead of phase 6.
Yeah, very good. I think what I've heard, certainly in our role as we work with clients, is around this whole custody problem and legal problem, which is something we've talked about a lot. The whole repapering exercise is a 9 to 12 month piece of work, irrespective of who you're working with and what you're doing. Still very manual, very, very typically from a law perspective, it's black lines, red lines, and people going backwards and forwards with documents on email. So pretty inefficient, but it is what it is. And we'll be dealing with it, I think, through phase 6 as well. Which brings me on to phase 6. We obviously have less than a year to go now. In fact, we've got 10 or so months to go. Phase 6 is due to be, by ISDA's reckoning, around 800 clients. I've had a couple of conversations with dealers this week around how many relationships they're talking about, and it ranged from 1,500 to 3,000. So clearly scope is getting enormous. It's a huge amount of redocumentation, repapering to do. What do we think the evolution of phase 6 is going to be, John? I guess I'm going to look at Acadia here, because you've been sat in the middle of the market, you've been coming up with solutions. Where do you think we're going to end up with phase 6 versus phase 5, and maybe some different challenges or same challenges?
Yeah, it's a good question, Shaun. And we're now laser focused on phase 6 from a company perspective, and we have been now since we kind of got over the finish line for phase 5. I think those numbers are still pretty accurate. I think we're estimating 650 to 800 firms in phase 6, right? And I think we're continuing to just kind of refine those numbers, speaking directly with phase 6 firms who are coming to us directly, or talking to their dealer counterparties to get a sense of who's in scope, who's going to move margin day one, who's going to be over the 50 million threshold, who's going to be under, and who's never going to move margin. So there's going to be another portion of phase 6 that may never move regulatory margin. They may never go under the 50. So we're still trying to ascertain that. I don't want to give people a false sense that this is going to be easy. It's going to probably be as hard or harder than phase 5. And I think all of the challenges that Katie had mentioned are going to remain. All the challenges, Shaun, that you kind of laid out just now in terms of doc negotiation and negotiating your eligible collateral schedules are all going to remain. It's just going to be a little bit, I would say, the volume is going to obviously increase. I don't think I'm saying anything that's not obvious, but I think looking at it right now, I don't think it's going to be 2.5 times, more work than it was for phase 5. I think it will be more work and more things to get accomplished from an industry perspective. But I think, it won't be markedly, that much more right now. I mean, that could change. Obviously, the ANA calculation period is much later in the year. So I think there are firms that are preparing to either figure out, am I over the 8 billion? Can I get under the 8 billion? How can I do that? And then, I think as firms start to really come out and disclose that they're in scope, we're going to get an even better understanding of, what their firm situation is going to be. And then we can ascertain that. But I think, we're going under the assumptions of those numbers, that 750 to 800 firms, and then maybe it's a third in terms of, who's going to go day one to move margin, and who's going to monitor, and maybe who's not going to move margin at all. So, but those numbers could change quite a bit as as we get more clarity as we move on. But the message is, and always has been, and this is what we tell our clients, to do it as early as possible, even if you can figure out that your portfolio will probably not change that much between now and your ANA calc period. The best thing to do is to start disclosing early. Look at your netting sets, calculate your ANA, figure out where you stand in terms of your exposure and potentially where your thresholds might be, and then get in early and start, testing. And we usually tell clients to start testing around January of the year that they're going in. But I think, that message is a little bit different this time around, mainly because of the fact that it is going to be the largest amount of firms coming into scope. So, that's kind of how we're looking at it currently.
Good. And Katie, I'll flip it back to you at JP. Have you guys approaching phase 6 any differently to phase 5? And I'm thinking about multi-managed funds coming into the equation a little bit more. Is that something JP Morgan are thinking about?
Yeah, I think we are. I think we're seeing definitely different client behavior in phase 6. I mean, we're all talking about there's a huge number of entities in scope, so that there's many more of them, but they're definitely less sophisticated, right? So a lot of these clients are not really as close to the regs, that don't have a grasp on really what needs to be done. So we're needing to be very prescriptive in terms of what processes need to be in place for their readiness. And I think that when it came to phase 5, clients were getting ready to post margin from day one, right? They needed a full set of end-to-end solutions. As we move into phase 6, clients are they got 1 foot in, right? They're captured by the regulation because they hit the 8 billion. But on the other hand, as they look forward, they realize they're going to remain under the threshold for quite some time. And that's a pretty consistent message we've had from clients, that they're captured, but they don't need to post any margin for potentially 2 years plus. So I think that changes sort of the story around readiness and what people need to do. I think there's a huge focus on the ability to monitor against those thresholds, and we're going to talk about that a bit more. But I think that from our perspective, you're sort of being very clear with clients. Well, what agreements do you think you need to be ready on? Which ones are likely to post? How far do you think you are on this? We've also sort of extended our tool set into the margin analytics space, so we can help clients, in terms of them predicting if they put on a new trade, what would be the margin impact of doing that. So we're trying to help clients further upstream on this process. And I think the other piece that we're really speaking to clients a lot about is custody versus tri-party. And I think the story really changes in phase 6, given, as I said, the clients are far less sophisticated, but their collateral balances are going to be much smaller, right? They're not going to post for a long time. So really tri-party becomes very, very costly for these types of clients, and really a sledgehammer to crack a nut. So I think that many of them are being pushed by their counterparties to go the tri-party route. But I think given the nature of their business and the size, that we'll see most of them go down the custody path. But I don't think all of them will get those custody accounts ready and set up for the 1st of September, because they simply won't need them. So I think back to my point around the full setup, I don't think we'll see that same behavior in phase 6. And it's more around what do people need to have ready to demonstrate compliance versus how long will it take them if they need their custodians to set up those accounts at a later date. So I think that given the number of clients that need to be ready for September, we need people to make decisions quite quickly, right? People need to be, clear and decisive about their operating models. So I think that, we're very much encouraging everyone we're speaking to make a decision and sort of get in the queue with their providers, their custodians, and their service providers in good time as they head into next year to ensure they'll be ready. And we're encouraging our clients very strongly to start those legal negotiations now and not leave them, because we know that we're talking about with 650 to 800 clients, but they're all facing off to the same banks, right? So from a legal bottleneck perspective, this is going to get worse. So people need to be pragmatic about their eligibility. So it's better if people are more standardized in what they're thinking from an eligibility perspective, and they're having those conversations early. So I think that phase 6 looks bigger, but the clients are smaller, and the collateral is less likely to move from day one.
All very valid points. Thank you, Katie. Mark, let's just keep that conversation flowing, because I think you've Transcend have been looking at this and working with different people in the market. Do you want to add some input here? I think it'd be good to hear from you.
Yeah, thanks, Shaun. We've been spending a lot of time in this space, in particular in the areas that we tend to focus. And sort of when I think of phase 6, there's sort of 4 areas that I think could be pain points for clients, and we're trying to address those problems. Some of it's connected to what Katie just said earlier. So the first thing would be in terms of connectivity to custodians. I think that's going to become even more critical, particularly as you're going to see more third-party custodians that are out there, and a lot of firms don't have that connectivity. And on the flip side, on the buy side, there may not be connectivity to the tri-party custodians. Why is this important? Well, it's important both from an optimization and what I'm going to call a collateral validation perspective. From an optimization perspective, the firm is going to need both to know the supply of collateral, so what they're holding at the custodian, and also have all the processes to be able to pledge that collateral and optimize it to a particular custodian. Similarly, on the validation side, if you're receiving collateral, you're going to need to be able to validate that that collateral that you received meets all the requirements per the agreement. And a lot of times that type of detail can be very detailed on the agreements. I've seen some things where like they're looking at coupons and the like. And so being able to validate the collateral on an end-of-day basis is really going to be crucial. So one key aspect is definitely going to be connectivity. We think also from a data perspective, being able to have harmonized data so that you can get a view of your inventory so that you're able to pledge collateral. A lot of firms have in the past only pledged cash, and now they need to pledge securities. So having an inventory, being able to project that inventory, understanding the impact if you have collateral where there's corporate actions and things like that, definitely important. The third piece I would say is just optimization processes in general. Some of the feedback we heard in terms of phase 5 was that firms were pledging very standard collateral because they didn't have the capabilities to pledge things like equities and the like. So being able to have sort of processes to support that, I think is important. And lastly, I'd probably say in terms of validation of collateral, validating collateral on the end from an end-of-day perspective, for many firms, they're required by their audit or regulators to be able to validate that the collateral they received is aligned with the agreement. And particularly for third party, we think that's really crucial. So Shaun, I'd say probably those 4 dimensions are the areas that we've been spending a lot of time on.
Thanks, Mark. I think the things I hear out of that all sit very nicely, and they're not just an initial margin story, right? It's a collateral story. People want to know what they've got, where it is, how they move it, how they get it back to wherever it needs to be. Has it settled? Is it validated? All of the things that we've talked about as an industry for a long time are now starting to bear fruit, in my opinion. So if I think about collateral management holistically, initial margin is one part of it, and clearly a growing part of our world for both cleared and non-cleared. But if you look at variation margin at the moment, just for the phase 1 deals or tier 1 banks, is around $1.2 trillion. And that's what's being exchanged by them alone. Now, clearly that has got increased hugely over the last decade as collateral management has become front and center since the GFC. I know, Nick, this is something that HQLA<silence> have been looking at quite frantically for the past year, how you guys can help the industry look at variation margin, look at settlement, look at how you can make the industry perform better, get more efficient. Maybe you could share some thoughts on that for us, please.
Yeah, but certainly, very, very happy to. And we at HQLA<silence> , we recognise that a lot's already been done by the first 5 phases, and we're coming at this with what I think is a fresh approach by taking our operating model that I outlined earlier, using new technology, distributed ledger technology, to in effect change ownership whilst leaving the securities where they are. We see this as part of a client tool set, if you like, whereby broadly speaking, to optimize collateral, you as Mark and others have discussed earlier, you need to know what you've got, and then you need to know how you can move it, or in our case, how you can change ownership of those securities as and when you want to. And so that's our fresh approach. And you're absolutely right, Shaun. We've been working with a group of interested buy side, sell side, and custodian / tri-party players, as well as Acadia, to basically work out how we could best apply the HQLA<silence> model and this new DLT solution to bring about operational efficiency savings for clients who need to satisfy the variation margin requirements. So, this is something that that we try and pride ourselves on doing by helping clients solve particular pain problems. We don't necessarily dream up these pain problems ourselves. We listen to our clients, we work with them, and this was definitely the case with this one. It kind of very much came to us that from clients that there was a need to do something here, and we've got a group of, as I said, a working group together to try and help solve a problem more broadly for the industry. And what comes of this is also enabling the receivers of the variation margin collateral to easily use, or what we call reuse, the collateral in subsequent transactions, as you would expect, whether that's for onwards purposes, for initial margin purposes, or more regular title transfer transactions like repos and sec lending. And I think the other goal of this initiative is to try and reduce some of the settlement risk friction which exists today, especially when substitution of securities is required. And of course, this is all part of just trying to enable clients to not only optimize when they're giving variation margin collateral, but also to reuse it on the other side. We think this is very, very key to the industry, and if there's something we can do here to improve the overall processing efficiency of the, of the 20% or so of the 1.2 trillion number that Shaun quoted earlier, then we think this could have a significant benefit for all. So really, HQLAÁṉ in this context is just trying to add an additional tool to the overall client toolbox to help them optimize their collateral.
Interesting stuff. We've obviously followed on from the panel that talked about optimization, and what I took away from listening to that was that everybody's been doing this at a different rate of knots. So I worked on an optimization desk in 2012, 2013. People are clearly, some organizations are clearly much further forward when they're doing it. I think where your offering becomes quite interesting, Nick, is that you're able to jumpstart people into something they potentially not necessarily thought about. I know, Mark, you guys have been working on optimization for some time at Transcend. How do you see this now sort of evolving, this optimization piece? Is it going to suddenly, I've got to start posting IM, everyone's going to start optimizing, or are we going to be still in this position or situation where I think the largest organizations, both sell side and buy side, are interested? Actually, that pre-trade, post-trade optimization question becomes maybe a one or the other rather than let's do both. What's your view on that, please?
Yeah, I think to your point, I think it all depends, on the firm. But what we do see is that firms are realizing that they need to look at optimization more holistically. That just looking from a siloed point of view is not necessarily getting them the optimal use of the collateral, and indeed that costs quite a bit in terms of the opportunity cost there. And so, for example, using a piece of collateral that's on special in the repo market to pledge as margin or things of that sort, can be costly. So I think, from our side, we're definitely seeing it, and we're seeing it not only on the dealer side, but also on the buy side. So as the buy side starts to get more involved in the repo markets and the stock lending markets and the like, there's a desire to not only optimize within the particular container, if you will, as in OTC derivatives, but to go across the different groups. And so we spend a lot of time basically having the harmonized data that enables us to do that, and the connectivity to do that also. And each market impacts the other market. So, for example, in our market, it may be in the OTC derivative market, you may only have one call a day. In other markets, it would be multiple calls a day, but they impact the choices that you make, even for the OTC derivative market. So being able to sort of have a holistic view, we think is helpful, maybe in different degrees, and your optimization algorithms that you use may be more significant for counterparties that have larger collateral pools, et cetera, but still important. But we tie that to, in order to be able to do this, and I've kind of brought it out before, is being able to connect to all the different depositories. The example, and even in HQLAÁṉ, I think my view is in the future that that's going to be another forum, if you will, in terms of settlement, frictionless settlement, if you will. And so being able to handle that from a real-time perspective, being able to optimize across all of that. In the future, if folks use other tokens or cryptocurrencies, being able to incorporate that also. The other piece I would add in terms of optimization is even just cash. With variation margin and the like, there's a lot of different uses of cash, and you want to make sure that you're optimizing the use of cash, whether it be for variation margin or not. So we're kind of looking at it, from a holistic perspective, knowing that each client has different requirements in terms of their levels of optimization. To your point, Shaun, some of it's pre-trade, some of it's post-trade, but having the analytics to be able to assess the different options that are there, we just see as critical. And so that's really where we spent quite a bit of time.
Great, thank you. I've heard the word friction today a few times, and it's a word I like because we don't operate in a frictionless world. The markets particularly can be full of friction. And so it sort of turns the wheel on its head a little bit, and we start thinking about interoperability and market interoperability. Lots of vendors out there. We have a slide at MarginReform that talks about the overall collateral ecosystem. It's a busy slide. There's a lot of vendors, a lot of players in the market. It's confusing for me, and I've been in the market for 30 years. It's confusing for clients, very much so. So where do we think and how do we think that market interoperability needs to change going forwards to A, make life more simple for people when they're making choices about technology or where they're going to spend their hard-earned dollars, but B, how does it make the market more efficient? And Nick, maybe I'll come back to you on that one. So I guess you guys are looking at this as part of your sort of new setup. So if you could maybe just expand on that a little bit for us.
Yeah, this is a great question, and we hear this theme quite a lot from clients, and we certainly recognise it, which is kind of why we've taken what I would call an agnostic approach to working with other platforms and providers, where it makes sense to do so in order to address specific pain points for our clients. But we're also conscious of the fact that the end result should be easy to use, easy to onboard, easy to integrate, even if you like, underneath the covers, there might be more than one provider, helping to deliver that solution. We've taken this agnostic approach, thus far with our platform. We've connected to a number of leading custodians and tri-party agents focused on Europe to begin with. And we think that that alone has achieved a level of interoperability across disparate collateral pools, and we would look to extend that philosophy, with respect to third-party, additional service providers out there in the marketplace. And I've mentioned on this call already that we're working with Acadia on a particular use case for variation margin, which we're very excited about. So we definitely recognize this potential view that it's creating complexity, but I think if it's managed successfully, then it can lead to a simpler solution overall, as long as everyone remains mindful that it's the client that needs the solution and that they're the most important.
Yeah, understood. I think it's, and I'm going to jump to you, Katie, because I think actually I look at it from a different perspective. If you're a vendor, you're always servicing your client. A bank, obviously, everyone's commercial, but Katie works for a bank, clearly giving away some of the bank secrets is not what JP Morgan want to do. So, Kate, how do you view that sort of internally when you've got clients who want to have different connectivity? What do you guys think about at JP?
Well, I think that, we just heard the word agnostic. We're also as a collateral manager and a provider of collateral management services, which historically we always did for variation margin, and now we do on a large scale for initial margin. We're sort of custody and tri-party agnostic. We provide a full set of services, and people connect to JP Morgan custody and tri-party, but we can also connect to other custodians and tri-party agents. So we're realistic in terms of how the market operates and works. And some clients already have sort of very established relationships with their existing global custodian, but they think we're the better collateral manager, or they may have a setup already with Unclear, but they want to use our collateral management or vice versa, right? So we've consciously been, very open in terms of, as I think about the UMR and I think about heading into phase 6, I think that the ecosystem is confusing when you speak to these clients coming into phase 6, as you start talking to them about, being collateral providers and receivers, right? You'll often have a meeting with a client and you'll explain to them the different models, whether it's custody or third party, and, the calculation of the IM. And then you'll say, listen, but this all relates to where you're providing collateral. And then you sort of flip it over to them and talk to them about being a receiver. And, that's where this whole topic becomes, mind blowing for some organizations that certainly, they could decide that they're going to use JP Morgan, right, when they're providing collateral, but at the same time, they're going to have to connect to multiple tri-party agents for their receiver. So we've also tried to, be very smart about how we streamline and we provide reporting back to our clients, that we consolidate all of that information for them. We gather that for them and report back, because we know that the ecosystem is, it's a complex web, certainly as it relates to UMR, if we're thinking about that and the different components and providers. And in our operating model, we use, we work closely with Acadia and a range of other providers, and we've tried to be very smart about how we do that. And we realize that partnering with certain companies is a better approach, and being custody agnostic and being able to instruct multiple places is also what's needed. So we've been quite thoughtful about this when we speak to clients, how we can help and how we can simplify.
Very good. I think it's really good to hear that kind of analogy coming out of one of the largest players in the market. I think that's good for clients, it's good for everybody else. It's good to have that sort of interoperability. I don't know, John, you're nodding. Acadia, if I had $1 for every relationship Acadia had, I'd have a lot of dollars. I know you guys agree with that whole connectivity, educational part, which is great. Sorry, we've got, if you can add something.
Well, I guess what I was going to say was, and it was kind of interesting as Katie and Nick were both talking, is that I have as a company either connectivity, partnership, or a pilot with everybody on this panel. We have more. We have like 20. And I think one of the thoughts is just taking it back to UMR. I had started thinking about how it has done and affected our industry so much in so many different ways. I think one of them was the fact that we've actually, as an industry, gotten closer to regulators, which was a good thing, I think. But it also has brought what we would normally look at as competitors in especially in technology together, right? Where look, we've built quite a few great products, but you can't build everything. And seeking out what is complementary to your business and to others in this great, like what we always want is a win-win situation, has been something that that UMR has completely done, right? It's kind of brought the industry together. I know your wheel or your diagram of all the solutions out there is still pretty complex. But a lot of those people are definitely working together or trying to work together. And, I think that can only lead to good things, generally speaking. It's not going to lead to everything good, but for the most part, I think it's a good development. So, anyway, that was the thought I had, but go ahead.
Very good. We would agree with that at MarginReform. So what we've seen as we talk to clients is that they want to work with winners, right? They want to work with the firms who are going to be here long term. If we look at ISDA-SIM as an example, not picking on ISDA-SIM as an example, I think there are 25, 30 people can now provide ISDA-SIM. Now, clearly, some have cornered the market and some haven't, and therefore you need to pick and choose carefully. And we would always say to clients, just look at what's going on, look at who's doing what, follow the herd to a certain extent when it comes to regulatory compliance. That's really the reality of what you should be doing. But that being said, clearly the world evolves, it changes. We've seen various announcements in the last 6 to 12 months of JVs, mergers, new firms coming out of a couple of firms who've combined. So, and Mark, I'll start with you. Where do you see the market heading in sort of the next 3 to 5 years from a technology perspective? And blue sky, I'm not looking for anything just specific to UMR, but from a Collateral perspective, where do you think we may end up, or where do you see the journey of travel heading?
Do you mean in terms of from a partnership perspective, or just
in general from a technology perspective? I think what we've seen with partnerships is that people are starting to say, right, we need to simplify things down, right? We've got partners out here who've got complementary models that we can join up. So maybe it could be there's going to be more firms joining together, or it could be that we're going to see DLT or crypto or something really accelerate the collateral market. So I'm really open floor to you guys to give me a bit of blue sky thinking. Sure. As to where I think the next 5 years takes.
Yeah, just a few things. And I was just reading a paper the other day, I think it was from the FIA, in terms of standards that they were thinking about from their processes and the like. And I think one of the things that you're definitely going to see is that industry groups are going to start to, we've heard this in the past, but I think it's becoming more critical, is that with CDM and the like. So I think one thing from a data perspective is you're going to try to see some harmonization. Given we're an enterprise firm, we particularly like the idea of things going across products. So I know the expansion of CDM beyond OTC derivatives is helpful in that regard, because otherwise you spend a lot of time in terms of harmonization. I think other things in the future, and a little connected to what I said before, I think connectivity to more and more players and more real-time connectivity. And I think that's becoming more crucial because things are becoming more intraday. When you have something like HQLAÁX, which is almost instantaneous settlement, and you need to be able to track all that type of thing. I think from the agreements perspective, they may be even refined more than they currently are now. I mentioned earlier that it can really get to the fine level in terms of being used for optimization or validation, but potentially you're going to see things such as ESG criteria and other things like that that may be part of the choices in terms of pledging collateral. And I think you're going to see, and this drives a lot of the partnerships, just firms wanting to get more front to back and more horizontal. So front to back all the way from the front office pre-trade all the way through to settlement and connecting in that kind of way. And also horizontal in the sense of looking across all the businesses, much like we spend a lot of time, and being able to realize that one always impacts the other and you can't look at them necessarily as not being connected in some kind of way. And I think the last piece is just in general, a real focus on the data and connecting the data so that you can look at it in many different ways and then generate analytics that help you to sort of simplify all that complexity and make good decisions, whether they be on settlement, whether they be in optimization, any of the different pieces of the pie, if you will. So if I was looking at sort of the environment, those are some of the things that I might see, in terms of the future trends.
Very good. Thank you. Nick.
Yeah, I'm happy to add to that. I mean, I think I agree with everything that Mark said. I think frankly, the good news is for the industry that there's a lot of players out there focusing on improving things, to be blunt. And I think that's just good news all round. I agree with the point made regarding data. I think that's very, very key. And I know that obviously HQLAÁX uses distributed ledger technology in a particular way, but I do think that there will be more use of DLT going forwards to as Mark said, ensure that there's consistent data, that it's shared data, everybody's looking at the same data, and that makes sense actually across organizations, but it also makes sense within organizations as well. So the earlier point about horizontal and vertical, even within an organization, you can have a lot of data points internally, and they all need to be reconciled in order to ensure the most efficient internal processing from an operational perspective. So I think and I think we're already seeing, DLT kind of emerging in the regulated capital market space, and I think that's a good thing for all. I think the other area in terms of opportunities for new technology, I think, is obviously optimization solutions, and I think that those are. I think they clearly started earlier than perhaps DLT did, but I think there's probably some way to go on that as well. To more broadly apply optimization solutions where it's needed. And then, of course, interoperability, that's going to be very, very important going forwards to the points made previously. But overall, I think it's just very good news for the industry that there's just so much focus on better solutions and digitization generally.
Loving the positivity. Katie, keep it up. What have you got for me?
What does the future hold? My crystal ball. So I think that at JP Morgan, our collateral management businesses and our agency lending and financing businesses form together what we call trading services. So we really think about all of these topics together. So I think what Nick was just saying in terms of the innovation around the optimization side, I think that's where we're certainly very focused, as clients want to make sure that the optimal use of their inventory, and they're not sort of using a security for initial margin that would have better value in the lending market. So I think mobilization and optimization are key topics on our side. I think in terms of the future, we're certainly hearing more and more clients that are sort of really pushing us to help them consider using tri-party structures for variation margin, right? And I think that I think that we as a collateral manager see that this makes sense. So it'll be interesting to see, how the future on that plays out, right? And whether we can get all the banks to the table on this. But I think that tri-party is a mechanism to collateralize VM, and I think it's quite interesting some of the what Nick was saying on this as well. I think that, we're definitely hearing from some of the bigger clients in the industry that, have really see the value in tri-party now that they're using it for UMR. They'd like to extend that into the VM space and, gain momentum on that efficiency. And I think that as it relates to UMR and derivatives collateral generally, I think, we'll see an extension in terms of what clients are using, right? Just beyond cash and fixed income. I think there's more rumbling in terms of people wanting to use equities. We definitely hear from the APAC and Australian client base, a desire to use equities. We've had, inquiries on money market funds. So I think we will see an evolution on this as well in the years to come. So I do think it's a fairly exciting time, and I think that definitely feels like a positive momentum, sort of for collaboration and efficiency. So
very good. We certainly, again, I reiterate that we certainly have conversations with clients today where we're talking about eligibility of collateral, and the regulatory side of it, the RTS is fairly prescriptive, but it does go down the credit quality scale. You can go and use equities, gold, corporate bonds, right? You don't have to be stuck in this cash HQLA world where you're only posting US treasuries or dollars or sterling. So it is going to evolve. And John, lastly, I guess over to you guys at Acadia. You've got this new sort of risk collateral thing you're doing. Where do you see the industry going in the next 3 to 5 years?
Yeah. I mean, I'll echo everyone's sentiment. I think it's an exciting time. I think, it takes a lot of courage for people to recognize that there is a problem and then really speak out and push the industry, whether it's you're pushing your clients or you're pushing your solution providers to say, hey, I have a problem. I heard you have a solution that could help. Let's work together. And I think the fact that I've been seeing more and more collaboration, and if you've been around this industry a long time, like you and I, Shaun, we both have grayish hair, right? You didn't see that. You didn't see a lot of that back in 20 years ago. Everyone kind of said, I had the solution, and come to me, which in large part still exists somewhat, but there is a sense of community that's happening. I've witnessed anyway, especially being on this side of in Acadia, where people are recognizing that clients want more. They want more efficiency. They want to lower costs. They just want to improve what has kind of been the process for quite a long time, which is not the most, especially in the OTC derivatives world, not the most efficient, not the quickest, the best. And we're constantly looking at least from my perspective, constantly looking at what can we build to accommodate that? Who can we partner with to help us accomplish those goals? And I think technology, as Nick was saying, I think technology, especially DLT, is going to play and will play a big role in that. Technology will probably drive all of this. And Mark mentioned CDM. I think efforts around normalizing and standardizing data is another great component of it. And if you look across the bank side of things, data rules everything. And you're almost as good as your data. And if your data isn't good, you're not going to be efficient. So, all of these little pieces of the puzzle seem to be coming together. And, it may not be as fast as some people want, but I think eventually in 5 years, I think this industry is going to look even different, more different. I think all the efforts around optimization, as we've been talking about, are going to come to fruition. People are going to really be able to take a step back and, as the dust settles on regulatory compliance, hopefully, as we know, there's probably going to be new regulations at some point again. But at least in terms of UMR, people are going to have at least more time to look at their organization and say, okay, what else could we do to make our organization better, more efficient? How can we lower costs, et cetera? So I know that stuff has been going on for a while, but I think that's going to continue. And I'm very hopeful. I think it's a good time. It's a good time to be in this industry for sure.
Excellent stuff. So I'm going to summarize there. I think that's a really nice way to end it, because we've had a lot of sort of positivity come out of that, which is in and around sort of the interconnectivity of the market, the fact there's a community there now there never used to be, certainly wasn't pre-crisis. I think what I've heard there, a lot around data and harmonization of data and things like UTIs on the derivatives, unique product identifiers coming out next year. That connectivity is going to be really crucial to make sure that those kind of things work, getting buy-in from the industry, whether it be sell side or buy side. And if I was to think back to earlier in the session, we talked about phase 6, and what we heard was get started, don't delay, speak to your custodians, speak to your technology providers, speak to consultancies that can help you, of course, but actually get started, right? Don't delay. But it sounds like we've got a really fruitful 3 to 5 years and more coming up. Clearly, regulation still plays a massive part in our world. We've got de facto phase 7, 8, 9, and 10 to come at some point in the future. But for phase 6, for UMR, we continue to grind the good fight. Clients need to get started, and we urge people to do that. So with all that being said, thank you very much to the 4 of you. Very insightful, lovely having you here. And back to Kevin.
Thanks, Shaun.
Well, thank you very much, Shaun, and the rest of the panel. I found that very interesting myself. I feel much more educated on where things stand. If boundaries existed between the securities finance markets and other parts of the financial markets world, it seems that those lines are blurring. I think that's got to be a good thing. Now, we're running very slightly ahead of schedule, so that gives us all a chance to have a 5-minute break. So we're going to just go to a slide now. I'll be back in 5 minutes to introduce the next session, which is on improving the liquidity chain. See you all soon.